In a world just brimming with financial reports, endless data, it can feel like you're charting unknown waters sometimes.
Yeah, just trying to find those truly valuable insights.
Exactly. But what if you could cut through all that noise? Discover the, surprising stories hidden in the numbers.
Well, that's pretty much our mission here at the Deep Dive, right? We take the raw stuff, the articles, research, those complex reports, and we boil it down.
Distill it into essential knowledge tailored for you.
Think of it as your shortcut to being genuinely well-informed, not just drowning in data points.
And today, we are diving deep into the recent Q1 FY26 earnings of Navin Fluorine International Limited.
Yep, we've been digging through their latest earnings call transcript, the financials, the investor presentation.
To bring you the core takeaways, and importantly, what they actually mean for this, well, fascinating chemical innovator.
So get ready to understand not just what happened, but, why it really matters.
Okay, let's pull back that curtain then. Navin Fluorine's performance.
Where do we start?
Yeah.
The top line.
Yeah, let's unpack these numbers. So, looking at their consolidated results for Q1 FY26 that ended June 30, 2025, the big picture isn't just growth, it's, pretty exceptional growth. What's the first thing that jumps out?
For me, it's just the sheer robustness of these figures. I mean, revenue from operations hit 725.40 crores.
Right, that's over 7.2 billion rupees.
Or about 87 million US dollars, yeah. And that's a 39% jump year on year.
39%. And even 3% up from the previous quarter.
Exactly. That shows a really consistent upward trend.
And the operating EBITDA, wow, that really soared.
It more than doubled, reached 206.8 crores. That's a 106% jump year on year.
106%. And still a healthy 16% bump quarter on quarter.
Which points to some serious operational leverage kicking in.
Meaning profits are growing much faster than sales because, fixed costs get spread out more.
Precisely. And the operating EBITDA margin really highlights that efficiency. It stood at a very strong 28.5%.
28.5%.
Which is a huge improvement year on year, 935 basis points.
So that's like a 9.35 percentage point jump in their margin. Huge.
Yeah, and profit after tax, PAT, that also grew impressively by 129% year on year to 117.17 crores.
So for you listening, these aren't just abstract numbers. They really paint a picture of a company in strong financial health and one that's executing incredibly efficiently. What does this kind of rapid growth, this underlying strength, tell you about Navin right now?
Well, it clearly signals a business that's not just growing the top line, but is also, strategically disciplined in converting that growth into outsized profits.
Right.
It suggests focused management, maybe strong pricing power in some areas, and definitely tight cost controls.
And looking ahead, they also pulled off that QIP, their qualified institutional placement, right? That was in July 2025.
They did. A successful one, too.
That feels like a major vote of confidence, doesn't it? Raising 750 crore, allotting over 1.6 million shares at 4,680 each.
Absolutely. That underscores a really strong positive response from the big institutional investors.
And the purpose?
They've been quite explicit. It's to strengthen the company's balance sheet.
Okay.
Which gives them more flexibility, more capacity for future investments, future growth initiatives. It's a strategic move, really sets them up nicely.
So it strengthens the foundation, lets them capitalize on the growth we're seeing across the different business segments.
Exactly.
Okay, let's unpack those segments then. Starting with high performance products, HPP. This was, 45% of their Q1 revenue?
Yeah, 45%.
Yeah.
And it showed really strong 45% year-on-year growth itself.
So matching the segment contribution percentage, interesting.
Indeed. And a key driver here is their R32 plant. That's the one making a crucial refrigerant gas.
Right, that came online back in March 2025.
Correct. And now it's running at optimal capacity. Apparently, global demand is really accelerating.
Shows good timing, good agility in capturing that market shift.
Definitely. And they're not resting on their laurels either. They're already in talks with international partners to expand R32 production further.
While carefully managing, as they say, product realization, basically getting the best price for shareholders.
A forward-looking approach. And at the same time, their AHF project that's in hydrofluoric acid.
The big 450 crore investment at Dahej.
Yeah, that one's moving along steadily. They're targeting completion by the end of Q2 FY26.
Which gives them more control over a key raw material, right? Vertical integration.
Exactly. Bolsters their whole setup.
And talk about focusing on niche markets. They've got that exclusive tie-up with Boost Chemtech
The Swiss company, yeah.
for electronic-grade HF. So this isn't just about bulk chemicals.
No, not at all. It's about high purity, very specialized applications, specifically for global electronic markets.
So thinking about these partnerships, these
Well,
expansions, how does this position them in what are pretty competitive global
well,
markets?
they're clearly aiming for the high-value specialized segments, not the commoditized stuff.
Mm.
This focus on advanced materials, high-purity applications, especially in electronics, it gives them a strong competitive edge, and usually higher margins, too.
It fundamentally differentiates them, you could say.
I think so, yeah,
Mm.
in the broader chemical landscape.
Okay, let's shift to specialty chemicals. That was 35% of revenue in Q1.
Also showing healthy growth, 35% year on year.
And they're saying capacity utilization is optimal at Dahej and Surat.
Yep, running well, and they have strong order book visibility for the full financial year FY26.
What's significant here? Anything new coming through?
Yeah, this is interesting. They're expecting upcoming supplies for 3 new molecules starting in Q2 FY26.
Okay.
And they specifically mentioned 2 of these have substantial potential for future investment.
So the R&D pipeline is clearly feeding into actual production, new high potential revenue streams.
That's the idea. Plus, their big fluoro specialty project, the 540 Core 1, launched last December.
Right, December 2024.
That's expected to make a meaningful contribution this year already, aiming for full utilization by FY27. So another chunk of capacity coming online.
They've also got that partnership with Chimmers, haven't they?
Yes, to make Hummer's proprietary option fluid. It's a 2-phase immersion cooling fluid.
For data centers and things like that.
Potentially, yeah. Project execution's underway, and commercial production should start in Q1 FY27. Apparently, that's a relatively smaller scale project, so ramp-up should be quick.
What about the broader market? They mentioned agrochemicals, right? ATKM?
Yeah, they touched on that. The context is the agro segment is recovering slowly. The big inventory destocking issues seem to be over.
Ah,
But there's still intense competition from China, putting pressure on pricing. So they expect volume recoveries, but more in the second half of the year. It won't be like a sharp V-shaped recovery.
more gradual. Okay. So you look at this pipeline new molecules, the Fluoro project, the Chimmers deal. What does this mix mean for their long-term stability, especially in a market that, fluctuates?
Well, it clearly demonstrates a strong commitment to diversification and just continuous innovation.
Mm-hmm.
By consistently adding new, high-value molecules,
Mm-hmm.
forming these strategic partnerships, they're basically reducing their reliance on any single product or market cycle.
Building resilience.
Exactly. Building a more resilient, stable, long-term revenue base.
Yeah.
That kind of foresight really differentiates them, I think.
Okay, last segment. CDMO Contract Development and Manufacturing Organization. That was 23% of revenue.
And achieve 23% year-on-year growth. Again, solid.
They've got strong revenue visibility here too, backed by a robust order book for FY26. This is their service side, essentially, where they make custom stuff for clients.
Precisely. Developing and manufacturing for others. And infrastructure expansion is key here.
Right, the CGMP4 facility expansion.
Yeah, phase 1, that's current good manufacturing practices. It's 160 crore investment, and it's on track for commercialization in Q3 FY26.
Adding crucial manufacturing capacity.
For their clients, yes. And they've had some good news on the regulatory front, too. Encouraging approvals from U.S. and European regulators for a label extension on a molecule under a European Master Supply Agreement, an MSA.
Okay, good progress.
Plus, they got a scale-up order for another late-stage molecule from a major EU pharma company, with supply starting in Q2 FY26. So, momentum on multiple fronts.
That's great. And they have this strategy, this balancing act.
Yeah, that's quite interesting. They aim to balance the early-stage molecules, which might be 40–50% of projects by number.
More projects, maybe riskier?
Right. With the late-stage and commercial molecules, which make up maybe 60–50% by value.
So fewer projects, but bigger value, more certainty.
Exactly. It builds a strong, sustainable pipeline while managing the inherent risks in drug development.
Smart. And what about future capacity?
Phase 2 of the CDMO expansion, another 128 core capex, that's basically trigger-based, meaning they'll only pull the trigger on that investment when the current plant utilization hits 60% or more, and they expect it'll likely be for a specific EU majors product.
So they're not building capacity just for the sake of it. Ensures continuous headroom, but based on actual demand.
Very disciplined approach.
How do they manage all this growth while keeping that strategic mix of projects and partnerships so balanced?
It seems to come down to, well, incredible discipline, like you said. Balancing the riskier early stuff with the more certain late-stage stuff ensures steady revenue while they invest in the future.
And that trigger-based capex for phase two just shows smart capital allocation again, only expanding when the client demand really justifies it.
Exactly.
Okay, let's shift gears slightly. Talk about their strategic financial framework, their operational excellence. They've actually expanded their capex ambition, haven't they?
They have. They moved from talking about maybe 500, 600 crores to now a wider bandwidth of 700 to 1,000 crores.
That sounds like a big jump.
Well, they clarified it's not necessarily a fixed annual commitment. It's more like a bandwidth for spending over the next couple of years. It reflects the strength and flexibility they now have on their balance sheet, partly thanks to that QIP, gives them capacity to invest when good opportunities pop up.
And they're still disciplined about how they spend it.
Oh, yeah. They emphasize aligning it with strategic priorities, new product plays, maybe new verticals, ensuring strong economics, and having that hopper of projects ready to mature.
They mentioned incubating advanced materials too, didn't they? And dialogues in semiconductors, data centers, going beyond just that electronic grade HF.
That's right. So you have to ask, where do they see the next big aha moments coming from?
And the answer seems to be
These new high-value tech-advanced sectors. Exploring advanced materials, semis, data centers.
Yep.
It suggests they're positioning themselves right at the cutting edge of where industrial demand is heading.
where their deep fluorine chemistry expertise can really create maximum value.
And potentially even disrupt some existing markets, yeah.
What's also remarkable is how they maintain such high margins. We saw that 28.5% operating EBITDA margin in Q1. That's way above their historical 25% guidance.
It is. And they broke down the drivers quite clearly on the call.
Okay.
Roughly two-thirds of that margin uplift came from pure operating leverage and internal efficiency improvements.
So their own hard work, basically.
Exactly. And about one-third was helped by strong pricing for R32 and just a favorable external environment.
So management's feeling pretty good, but cautious.
Cautiously confident, I'd say. They expect to stay north of 25%, so above that target. But they want to wait a couple more quarters before formally changing the guidance.
Focusing instead on just continuous manufacturing excellence, cost savings.
Right. Keep doing what they're doing well.
So beyond the market helping them out a bit, how do they keep optimizing internally to deliver that kind of profitability year after year? What's the secret sauce?
I think it's just a relentless focus on efficiency across everything. Optimizing how they use their assets, making sure new plants are commissioned on time and ramp up smoothly, implementing continuous cost-saving programs, leveraging their scale to get better purchasing power. It seems ingrained,
Yeah.
part of their operational DNA.
Right. Okay, finally, let's touch on their commitment to innovation and sustainability. Because Navin Fluorine is, well, quite an R&D powerhouse.
They really are.
Yeah.
They invested nearly 55 crores in R&D just in FY25.
With dedicated centers in Surat for HPP and specialty.
And in Madhya Pradesh and Manchester for the CDMO side, all focused on complex chemistries driving backward integration.
Making more of their own starting materials.
Exactly. But beyond the financials and R&D, their environmental initiatives are genuinely impressive.
Yeah, I noticed that too. It's not just boilerplate stuff.
No. Like in Surat, they're doing waste heat recovery, steam condensate recovery, cutting natural gas use, saving water.
And DOES is a zero liquid discharge facility.
Yep. Increased solar capacity there, better water recycling, minimal hazardous waste to landfill. And they even adopted the Miyawaki concept for tree planting.
That's the dense forest plantation method, right?
That's the one. And at Dahej, more condensate recovery, energy-efficient fans, converting to natural gas.
You know, seeing details like Miyawaki or the fact they've planted over 14,000 trees, it makes the commitment feel more tangible than just standard ESG reporting.
I agree. And they've got awards for environmental excellence. They're compliant with plastic waste management rules.
It seems pretty comprehensive, and this extends to governance, too.
Looks like it. A highly engaged board, lots of independent directors, and importantly, no audit qualifications, no allegations of financial funny business.
Reflects strong oversights, ethical practices. So stepping back, what does this broad commitment, R&D, sustainability, governance tell you about their long-term vision and resilience?
It tells me they're building a business not just for today's profits, but they're genuinely trying to future-proof themselves. Well, by investing heavily in R&D, they stay ahead technologically. By deeply integrating sustainability, they're proactively aligning with global trends, regulations, customer demands.
Which ultimately contributes to long-term resilience, sustained value.
Absolutely. It's about creating competitive advantages that are sustainable, that will last well beyond just the current market conditions.
Okay, and with that, I think we've unpacked Navin Fluorine's pretty impressive Q1 FY26 performance.
Yeah, we've seen strong financials driven by strategic expansion in HPP
Smart diversification in specialty
and
chemicals.
that robust, evolving CDMO business.
Their disciplined capital allocation, that unwavering focus on operational excellence, innovation, sustainability,
Yeah,
it really paints a picture, doesn't it?
it does. A picture of a company actively shaping its own future in these high-value niche markets.
So, as Navin Fluorine keeps leveraging its deep fluorine chemistry expertise, especially in these specialized electronic grade areas, it kind of leaves us with a thought, doesn't it? In this increasingly complex, fast-moving global economy, how critical is it really for companies to truly own and continuously innovate around their core high-value chemistries, to ensure they have that sustained competitive advantage and real long-term growth?
That's a profound question for pretty much any business navigating the future, isn't it? Definitely one worth pondering.